Minasan konnichiwa, Zamurai Engineer desu. In this lesson, we will talk about Chapter 10, Lesson 2, which describes the major characteristics of bonds. Long-term liabilities are obligations that are expected to be paid after 1 year. Bonds are a form of interest-bearing notes payable. Usually, bonds are given or offered by the government in our country, but in other countries, bonds are offered by almost every public corporation. Okay, so excuse. Bonds sold in small denominations, usually $1,000 or multiples of $1,000. You can have many, as much as your investment money can buy. Attract many investors, public. Okay? Corporation issuing bonds is borrowing money. They are offering bonds, but actually they are borrowing from the public. Person who buys the bonds, the bondholder, is investing in the bonds. You are an investor if you buy bonds. Okay. So types of bonds: secured bonds and unsecured bonds. Okay. Secured bonds, what? Bond certificate and with asset as collateral. However, unsecured bonds with bond certificate alone with no asset collateral. Okay. Bond can convert to stock. There are bonds that can be converted to regular stock, common stock. Okay. Because the difference that you are a stockholder rather than you are creditor. Okay, and you will gain, as a stockholder, you will get dividends from the company, and you share the profit of the company. But if you are creditor, you are just what? Getting the interest from the bonds. Okay? And callable bonds are bonds that day to day, it is not, they are long term, but it can be traded much easily. Could be traded much because bonds are long term. They wait for maturity. However, you can sell your bonds, but you get the interest at a specified period of time. But now, if you are an investor, you want an immediate returns on your investment, you can trade it any given time. So that is one of the idea. Bonds issuing procedure. State law of United States grant corporations the power to issue bonds. Okay. I don't know if that is granted in our country. I am not aware because I am aware that only the government issue bonds in our country. I don't know of any public or private corporation for that matter that issue bonds themselves. Or maybe they can issue bonds but with the permission and approval from the government Securities and Exchange Commission. So I'm not aware of this. So please, if any one of you are aware of this, please help us comment on the comment section below. And all of you who are student of this course, please research on this as your assignment and answer this as an assigned question on the comment box below. Okay? Board of Directors and stockholders must approve bond issues for every company. Okay? Board of Directors must stipulate number of bonds to be authorized, total face value, and contractual interest rate. So they are fixed. Okay? Bond terms set forth in legal document known as a bond indenture. Bond terms, the terms written on the legal document are known as bond indenture. So bond certificate typically usually a $1,000 face value. Usual, traditional. Okay? So these are the important things to talk about. Face value of the bond and the interest of the bond. The terms written on the bond, this one, are called bond indentures and bond certificate amount usually. So let us talk more about this. Represents a promise to pay sum of money at designated maturity date. That is what I am talking about previously. Plus periodic interest at contractual stated rate on maturity amount. Okay. You already have interest at contractual rate on maturity or face value. You have to agree if the payment of interest is at once or at regular interval. So it depends on the offering, the bond offering. Interest payments usually made semi-annually. So this is one classic example, semi-annually. Some are quarterly. Issued to obtain large amounts of long-term capital. So that is the purpose of the company. Investment company sells the bonds for the issuing company. So they are so many investment company that helps the regular company produce funds, additional funds for their operation through offering of bonds. And actually they market these bonds for the benefit of issuing companies. Okay, so let us continue. Sorry about that. Example of a bond certificate. Okay. For example, $5,000. So registered meaning it is with the permission of the government. Okay. So face or par value is written and the interest rate is also written together with its maturity date, which is what? Here is 2021. Okay. So, bond trading. Bondholders can sell their bonds on national exchanges. That can be done. So, for example, in our country, we have Makati Stock Exchange, Manila Stock Exchange. I think they converge into one, which is called Philippine Stock Exchange. I think they become one. So, your second assignment is to research. So, number one assignment is to research if in our country they allowed companies to offer bonds. And second assignment is research what are the exchanges existing in our country. What happened to Makati Stock Exchange and Manila Stock Exchange, and what is the current uh, Philippine Stock Exchange history. Okay? So those are the two questions for assignment. Okay. Bond prices are quoted as a percentage of face value. A quoted price of 97 means 97% of face value. For example, bonds, Time Warner, Cable, 6.675, maturity, June 15, 2039, close, 116.4, yield, so 5.49. Time Warner Cable has outstanding 6.675, $1,000 bond that mature in 2039. They currently yield a 5.49% return. At the close of trading, the price was 160.4% of face value. So, good. Very good, because it earns 16.4%. Very good percentage. Depends. Depends. But the thing is, that is only what? A document, and the maturity is what? 2039. About 20 years. Determining the market value of bond. Current market price, present value, is a function of three factors. Dollar amounts to be received. Number two, length of time until the amounts are received. And market rate of interest. Okay, so amount, time, and interest. The market interest rate is the rate investors demand for loaning funds. So even if you are what the company offering bonds, if you are the issuing company, having decided on the rate of the bond, sometimes the investor do not call your what call your bluff, call your offer, right? And they will not buy any bonds from you. So you have to offer an interest rate which is near or within the acceptable interest rate demand by the investors. Okay, because they will agree to use their money for your company's operation. So, determining the market value of the bond illustration. Assume that Acropolis Company on January 1, 2019 issues $100,000 9% bonds due in 5 years, with interest payable annually at year end. The purchaser of the bonds would receive the following two types of cash payments. One, principal of $100,000 to be paid at maturity. They will give back to you your money, same amount. And number two, 9,000 interest payment, because that is what? 5 years, no? Okay, 5 interest payments. So that is 9,000 times 5, that is 45 over the terms of bonds. So take a look at the figure below. So 9,000 for each year. So 9 times 5, that is 45 for 5 years. That is very high. It's very high. Only 5 years. You have what? Almost 50% of your capital in 5 years. So in 10 years, you have double your money. Okay? The current market price of the bond is equal to the present value of all the future cash payments promised by the bond. Okay. For example, present value of 100 received in 5 years. So they will compute this. Present value of 9,000 received annually for 5 years. That is present value. In 5 years, that is 45,000. Market price of bonds. So that is the total. How the company come up with the value of 100. Okay, so that is how. So using present value tables, we can compute this in engineering. That is what in our engineering economy. We don't need any table, but using the tables of computation, we can just look up the table and use the interest like this one. Okay? Very nice and reverse because what we are doing engineering in our major subject engineering economy is that reverse reverse computation. So uh, that is usually what we are dealing with, but now we are showing the real life application in the business side business side of things. We are doing this for the purpose of accounting and recording. So, and actually, when we are talking about what is the justification why we have this bond valued at $100,000, this is what happened. Okay, please take time to read this and just learn from it. You already have assignment on this lesson, so please work on that. And if you would like, you can also comment on this article. As an investor insight, it will add up to your preparation. You will become an entrepreneur later, become a businessman later on. Aside from being an engineer, aside from being a problem solver, you can be an investor and earn money for yourself and start your own business with this investor insight. Okay, so use this, and if you want, you can give your comments on the comment section below. Again, this is Dr. EYPEI, preaching engineering for nation building.